Hello everyone, welcome back to Remaster classes. In a previous video, we have discussed a problem on final accounts. Okay, you can find that video in I button or else link in the description. Okay, today we are going to discuss another problem on a final accounts. We'll start now. Okay, this is the illustration 3. Prepare a trading and profit and loss account for the year ending 30th June 2013 from the following trial balance from the books of Madhav Furniture Mart. Okay, what we need to do, we need to create trading account, profit and loss account, and a balance sheet of statement of it. Okay, we have to create this three. Now the trial balance has given. Okay, trial balance has given. From this trial balance we are supposed to create these three accounts. We'll read once. What are the entries has given? Opening stock, purchases, sundry debtor, bills receivable, plant, interest on loan, wages, building, loose tools, cash on hand, stationery, salaries, discount. In the credit balances, capital, sales, sundry creditors, bills payable, loan and mortgage, bank overdraft. These are the entries as given in the credit balances. Now you just will check the adjustments as well. What the adjustments has given? Closing stock is of 5600. Return of loose tools is of rupees 540. Interest on mortgage at 15% per annum. Provide interest on capital 5% per annum. Provide 5% reserves for doubtful debts. Okay, this is the problem has given in this. Basing on this problem, basing on this trial balance, we have to just go through with the final accounts. Sure, we'll start then. We'll take a pencil and we'll write which entry will come on which account. It could be a trading profit and loss account in a balance sheet or else in a balance sheet. We'll mention it like we'll by writing trading T, profit and loss account PL, and if it is a asset directly A, or if it is a liability L. Okay, now I have written all those things. I'll just explain you why it is coming on which side. Opening stock, profit and loss, opening stocks comes under the trading account, debit side. Purchases comes under the trading account, debit side. Sundry debtors is an asset. Okay, is an asset, so balance sheet, asset side. Bills receivable is an asset, balance sheet. Then plant, balance sheet, asset side. Interest on loan, profit or loss account. Wages, trading account, debit side. Building is an asset, balance sheet. Loose tools, cash on hand, asset. Stationery, profit and loss account, debit side. Salaries, profit and loss account, debit side. Discount allowed, it's showing debit balance, so it's a allowed, so in a profit and loss account, debit side. Now coming to the credit balances, under the credit balances, capital shows always it's a liability, so liability comes under the balance sheet. Sales, trading account, debit side. Sundry creditors shows in a balance sheet, liability side. Bills payable, liability, balance sheet. Then loan and mortgage, liability, balance sheet. Then bank overdraft, liability, balance sheet. These are the entries are going to be posted into the trading profit and loss account and a balance sheet. Now these adjustments, what the treatment used to be for with the adjustments, we need to keep in our mind all these adjustments. Whatever the adjustments used to be, it used to have two effects. Okay, dual effect. One effect used to be in a balance sheet 100%. Another effect could be in a trading or profit or loss account. Okay, trading or profit and loss account. So in that way, closing stock used to have a effect in the trading account. Okay, trading account, credit side. Okay, then return of loose tools. What exactly the return of loose tools? We are having loose tools over here, that's of 600. This is being written off. Okay, so this is going to be in a profit and loss account. Okay, profit and loss account in a debit side. Then interest on mortgage. Interest on mortgage, what exactly the interest on loan on mortgage is there na? So loan on mortgage, that's of 18,000. Over on that 15% we will be calculating and we will be giving it. Okay, we will be writing in the profit and loss account, that too in debit side. Then provide interest on capital 5% per annum. What is the capital amount? Capital amount is of 20,000. 20,000 in the sense 20,000, 5% of 20,000 we will be calculating and we will be writing in the profit or loss account debit side. Provide 5% reserves for doubtful debts. This is a doubtful debt. This doubtful debt is going to be calculated from the debtors. Whatever the debtors, sundry debtors you are having now, this 25,000. From this 25,000, we are going to calculate 5% and we will be writing it as a reserve for doubtful debts, RDD. Okay, reserve for doubtful debts, 5%. And we will be writing into the profit and loss account debit side. Okay, all these entries used to be there. Now we'll start the problem. Basing on this, first of all, first entry, whenever the business starts, in we need to create, we have to start with the trading account. Okay, when we speaks about the balance sheet, we should start with the trading account. Okay, trading account, then trading account, we then afterwards profit and loss account. Okay, profit and loss account, then balance sheet statement. Okay, balance sheet statement. So trading account used to have debit side as well as credit side. This debit side, all expenditures used to be there. Okay, all expenditures. Over on the credit side, all incomes used to be there, incomes and revenues. So basing on this used to happen in the same way over here as well. Okay, in a balance sheet, L stands for left hand liability, L stands for left hand side. So liability and asset side. Okay, this thing. All liabilities used to come over here, all assets used to come over here. Okay, under this, under the trading account, expenditures related to the factory, okay, factory and direct expenditures. Incomes, direct incomes used to be over here. Okay, direct incomes will be over here. Then under the profit and loss account, all expenditures related to the office or company will be over here. Any losses over here. Okay, profit and loss account works over on nominal account basis, or on the basis of nominal account, or on the rule of nominal account. Debit all expenditures and debit all expenses and losses, credit all incomes and gains. Okay, so in this way we used to just deal with the trading and a profit and loss account. We'll start the problem now. The first entry, whenever we start a trading account, we will be giving the heading. Okay, we'll have a format, particular amount, particular amount. Okay, then first entry used to be of opening stock. Okay, we'll just go over here. How much the opening stock is? It's of 5,000. You just see, it's of 5,000. Opening stock is of 5,000. Okay, we'll try to maintain in this way so that easily we can understand, easily we can see in a single way itself. Okay, in a single page. Then next one, where we have written T, this is the second one, purchases of 29,200. So purchases 29,200. Okay, then next one is wages. Wages is of 15,000. Okay, wages is of 15,000. You can see the wages, two wages, 15,000. Then we need to check any other entry related to the trading. Do we have? We don't have any other entry related to the trading account. Then we'll come to the credit balances. Okay, credit balances. Which entry related to the trading? That is sales. Okay, sales is of 62,500. So we'll see sales. By sales, credit balance 62,500. Over on the credit side, sales 62,500. Then what we will be doing, we will be checking any other entry which is related to the say particular credit balances. We don't have anything over here. We'll come to the adjustments. Okay, we'll come to the adjustments. Which entry is related to the trading, we'll see once. Closing stock comes under the trading account, that too in the credit side. This closing stock, without forgetting, we should write this one. Okay, this is going to have an effect over on here by closing stock. Okay, first effect, this is the first effect by closing stock. You can see 5,600. Okay, 5,600. Now what we need to do, we have to calculate this, we have to calculate this three entries. Okay, up to here we have to calculate. We'll take a help of a calculator and we'll see. First we'll calculate the credit balances, 62,500, then 5,600. It is coming as 68,100. Okay, 68,100, it's a credit balance. Now we'll go to the debit balances. The first one is 5,000, second one is 29,200, then wages is of 15,000. Is there any other? Nothing. We are having only three entries, so we got 49,200. So which one is the bigger number, whether the 49,200 or this credit balance that is 68,100? Obviously 68,100. So what we will be doing is, we will be writing 68,100 as a total on credit side as well as on the debit side. Okay, as well as on the debit side, this one. Now what we will be doing is, we will be subtracting 49,200 from 68,100. 68,100. We are getting 18,900. Okay, 18,900. So this thing is going to be like this balancing figure will be writing, we will write it as a to gross profit. Okay, to gross profit. It means your incomes are more than your expenditures. All these are expenditures, all these are incomes. Okay, incomes are more than your expenditure. That is the reason you are in a profit. 18,900 is your profit, to gross profit. Okay, to gross profit, and it is being transferred to where? Profit and loss account. Okay, this thing is being transferred to the profit and loss account over on the credit side. Okay, over on the credit side, it is going to affect over on the opposite direction. The reason behind is, the trading and profit and loss account works over on the nominal account principle. Okay, on a principle of a nominal account. Nominal account principle says that debit all expenses and losses, credit all incomes and gains. So it's a profit is a income or gain, so that basing on that we are getting over here, we are taking this over on here. If we just imagine, if our expenditures are more than our incomes, okay, expenditures are more than our incomes, then what is going to happen? We will be in a losses. So we used to write it over here like by gross loss. Okay, by gross loss, and this gross loss is being transferred to the profit and loss account debit side. based upon the nominal account rule. Debit all expenditures and losses. Okay, if we are having the loss, then definitely we need to write it over here by to gross loss. Okay, to gross loss. Okay, brought down. Over here by gross profit brought down. Okay, BD used to be over here. Okay, by gross profit brought down. This is but to gross profit carried down. Okay, this thing used to be there. Now our answer, our profit is over here. We have created a profit and loss account, particulars amount, particular amount. Okay, now particular we are having this particular thing like debit side and a credit side. We have written profit and loss account for the year ending 30th June 2013. Then this thing has been transferred by gross profit, brought down the same value 18,900. Okay, then what we need to do, we need to go to the problem again. Okay, we need to go to the problem. We'll check what exactly the entries are related with the profit and loss account. Then we'll discuss what to do, how to have a treatment for that. Okay, first we'll deal with the debit balances. Under the debit balances, we'll check where exactly the PL I have written. Interest on loan. Okay, interest on loan. This is the first entry has come over here. Okay, interest on loan, that is of 30 rupees. Sorry, 300 rupees. Interest on loan. You can see two interest on loan, 300 rupees. Then after that, write off loose tools, it's of rupees 540. Okay, two loose tools, write off 540 rupees. Okay, then we'll come to the another entry, that is stationery. You can see stationery, that's of 500. Stationery to stationery 500. Then next one, salary to salary, that's of 8,200. Okay, 8,200. Then discount allowed 100 rupees. So discount to discount allowed 100 rupees you have written. Then check for any other entry that comes under the debit balances, that shows the debit balances. Already we have done with the loose tools. Now interest on mortgage, that is 15% per annum. Okay, 15% per annum. So that what is it, the amount of a mortgage, we'll check once. Mortgage value is of 18,000. 18,000 into 15%, that comes as 2,700 rupees. So this 2,700 rupees is being posted over here. Okay, 2,700. Then next, provide interest on capital at 5% per annum. What is the value of a capital, that is of 20,000 rupees. 20,000 5%. Okay, 20,000 into 5%, so it's 1,000 rupees. We will be writing interest on capital. Okay, into interest on capital 1,000 rupees. Okay, then next one, that is provide 5% reserves for doubtful debts. 5% reserves for doubtful debts. It is going to be calculated over on sundry datas. Okay, sundry datas. Sundry datas is of 25,000. So 25,000 into 5%. It used to be like 1,250 rupees. Okay, 1,250 rupees. So this is been written like two reserves for doubtful debt, RDD, that is 1250 rupees. Okay, we don't have any other entry to be mentioned. Okay, left over to mention over on the debit balances. And over on the credit balances, we'll see is there any other entry is left over to mention in the profit and loss account credit balance. We don't have any. What we will be doing is we will be adding all these entries and we will be subtracting with each other, like we'll see which one is the bigger one, which number is the bigger. Anyhow, we are having the only single entry on the credit balance, that is by gross profit brought down, that is 18,900. We'll calculate this one on what, like the debit balances are like 8,200, then 500, then 300, then 100, then 1000, then 540, then 1250, then 2700, this much, yes, up to over here, done with 14,590. Okay, 14,590. We have received a debit balances are 14,590 rupees. So easily we can see this is the bigger number and this is a smaller number. So basing on that, what we will be doing, we will be mentioning this 18,900 on credit balance as well as on the debit balance, and what we will be doing is we will be subtracting this 14,590 rupees from 18,900 rupees. Okay, now you can see this 4,310 rupees is your balancing figure. Okay, is your balancing figure. So what you will be doing, you will be writing it as to net profit. Okay, to net profit carried down. Okay, carried down, and this net profit amount, the balancing figure you will be mentioning over here, that is 4310. Okay, this net profit is being transferred to the capital account. Okay, in the balance sheet. Now over here you can see we are starting a balance sheet statement. Under the balance sheet statement we used to have liability amount, asset amount. Okay, we are having a column, a liability amount, asset amount. So over on the left hand side, L stands for left hand side, L stands for liability. It should be on left side, because the student used to do the mistake, like they used to start with assets over on the left hand side and they will be writing liability on the right hand side. No, that is the reason I am telling you LL. Okay, left hand side liability. Okay, that thing. Chalo, we'll start with the first process, that is capital. How to deal with the capital, what the capital amount is, we'll see first. Our capital is of 20,000. Okay, 20,000. So Madhav's capital was 20,000, we have written in an inner column. Okay, in an inner column itself, what we have done, whatever the interest on capital was there. Okay, in adjustment we were having interest on capital, we have just calculated over here, that is 1,000 rupees. Okay, 5% capital, so it is being added. Okay, add interest on capital, 20,000 plus 1,000, that is going to be 21,000. Okay, then along with this 21,000, what we will be doing, we will be adding net profit, whatever the net profit we have received now, this 4310. So we will be adding this over here. Okay, 21,000 plus 4310, this is the net profit. From this, what we will be doing, we will be subtracting less drawings. Okay, less drawings. Any drawings if we have, just check any drawings are there in a problem. We don't have any drawings, so that what we will be doing, we will be writing as 0. Then when you add this, it will become 25,310. Okay, 25,310 is 0 is subtracted from the 25,310, in the sense it is going to be like 25,310 itself. So this it is going to write in the outer column. Okay, this is the procedure. Like this used to be considered as a closing capital. Okay, closing capital. Now we'll check the another liabilities, whatever the liabilities we are having, like sundry creditors we are having, that is of 13,400. We will be writing sundry creditors 13,400. Then next one is bills payable. Bills payable is of 5,000. Directly we have written bills payable 5,000. Then next one is loan and mortgage is of 18,000. We are having a entry. Okay, we are having an adjustment with this loan and mortgage. So basing on this mortgage 15% we have calculated. So this effect, okay, the first effect already we had in a profit and loss account. The second effect used to be in a balance sheet, loan and mortgage interest. That interest are going to be added with the loan and mortgage which we have calculated. So that thing we will be adding over here, 18,000 plus 2,700, that is going to 20,200. Okay, then we'll come to the next one. Bank overdraft is of 2,400. This 2,400 we will be mentioning. Okay, this thing up to over here, that's it. Now we'll come to the asset side. Now we'll start with the fixed assets, like whatever the fixed assets we are having, we will be mentioning asset side. The first one we'll just check once which one we are having. We are having fixed assets. We are having plant, that is of 10,000. Okay, plant is of 10,000, we can see over here. Then after that, which one we are having fixed asset, that is a building is of 24,000. This building 24,000 we have written. Then we are having loose tools is an asset. Okay, it's of 600 rupees. Okay, this 600 rupees we will be mentioning in an inner column. Then over on this we are having a particular adjustment. That adjustment is of write off loose tools 540 rupees. This write off loose tools is being subtracted from 600 rupees less write off loose tools, so that the balance amount, whatever the remaining amount, that is of 60 rupees, we are going to write in the outer column. Now we'll discuss regarding to the current assets. Current assets, the first current asset which we are having, that is datars. Okay, sundry datars. The datar is of 25,000. Over on the datar we are having one adjustment, that is of reserves for doubtful debts. Okay, reserves for doubtful debts, that is of 5%. Okay, we have calculated reserves for doubtful debts. What we will be doing is that at 5%, that is at 112, how much it is, it's a 1250. Okay, 1250 is being subtracted from 25,000 rupees. Okay, so what we will be doing, how the treatment used to be, the sundry debtors used to be written 25,000. Then what you basing on this, the treatment is less reserve for bad debts or the doubtful debts, whatever it is. So basing on that we will be mentioning, we are going to subtract this from 25,000, 1250 rupees is being subtracted, and the remaining amount is going to be mentioned in the outer column. Then next one, which and another one we are having, that is bills receivable. It's a current asset. We will be writing bills receivable entry, it's of 2,800 rupees bills receivable we have mentioned. Then we are having another one, uh, cash in hand. Okay, cash on hand we are having, that is 600 rupees we will mention. Okay, cash in hand we have mentioned over here. Then is there any entry which is left over, we will be checking. We don't have any other entry over here. We'll check the adjustments. Closing stock, it's an current asset, we are going to mention closing stock. Okay, this is the second effect. First effect has come in the trading account, second effect you will be in a balance sheet. You can find it over here, stock 5,600. Okay, then check for any other, like return of loose tools already discussed, interest on mortgage has taken, interest on capital has taken, this doubtful debts has also, the treatment has also done. So now what we need to do, we need to make a total of all debits, all assets and liabilities. We'll start with the liabilities side. 25310 plus 13,400 plus 5,000 plus 20,700 plus 2,400. It has come like 66,810 rupees. Okay, this is the amount. It is going to be the same over here. Okay, this thing. Now we will be adding the asset side. The first one is 24,000, then 10,000, then 60, then 5,600, then 23,750, then 2,800, then 600. It has come as 66,810. Okay, 66,810. So you can see this on both the sides, it's coming as equal. It means your balance sheet has tallied. Your balance sheet is showing exact, without any deviation, without any mistakes. You have completed your problem. In this way we have to do the final accounts. I believe, I hope you people have learned how to deal with the entries and how we will be doing the final accounts. Thank you very much for watching. Bye bye.